Hey everyone, it's Jerry Lowbrow here, and welcome back to my channel. Today, we're diving deep into the world of Forex trading, specifically a high-paced, adrenaline-pumping strategy known as scalping. Now, if you're new to trading, scalping might sound a little intimidating, but stick with me. For those unfamiliar, Forex scalping is all about capitalizing on small price movements in the market over extremely short periods, often just a minute or even less. It's like the coffee trade of the financial world. Quick, frequent, and can be highly profitable if you know what you're doing. Throughout this video, I'll break down everything you need to know about Forex scalping, from choosing the right indicators to managing your risk effectively. And hopefully, by the end of it, you'll have a solid understanding of how to implement this strategy for yourself. So, whether you're completely new to trading or a seasoned investor looking to add another tool to your arsenal, this video is for you. Let's get started. Now, when it comes to Forex scalping, one of the most crucial elements is speed. And I'm not just talking about your internet connection. In scalping, every second counts. Remember, we're talking about making trading decisions in the span of seconds or minutes. Unlike long-term trading, where you might have days, weeks, or even months to analyze market trends, scalping demands quick thinking and even quicker reflexes. You need to be able to process information, analyze charts, and execute trades with lightning speed to capitalize on these micro opportunities. This means you need a solid understanding of technical analysis, a keen eye for patterns, and perhaps most importantly, the ability to trust your gut and make split-second decisions. It's not for the faint of heart, but that's also what makes it so exciting. But speed without direction is useless, right? That's why having a well-defined trading plan is absolutely critical in Forex scalping. Think of it like having a roadmap for your trades. Your trading plan should outline your entry and exit points, your risk management strategy, and the specific market conditions you're looking for before entering a trade. This is not something you want to figure out on the fly while the clock is ticking. Having a plan helps you stay disciplined and avoid making impulsive decisions based on emotions, which can be a recipe for disaster in any trading strategy, but especially in scalping. Emotions are your enemy in trading. Remember, fear and greed are powerful emotions that can cloud your judgment and lead to costly mistakes. When you're scalping, it's easy to get caught up in the heat of the moment, especially when you see the potential for quick profits. That's why it's crucial to master your emotions and stick to your trading plan. Don't let a few winning trades get to your head. And more importantly, don't let a few losing trades make you doubt your strategy. Remember, even the most successful Forex scalpers experience losses. It's an inevitable part of trading. The key is to manage those losses effectively and not let them derail your overall trading plan. Keep a cool head, stick to your plan, and over time, you'll be surprised at what you can achieve. Now, let's talk about technical indicators. These are essential tools that help traders like us analyze price charts and identify potential trading opportunities. They're like our trusty sidekicks in the world of Forex scalping. There are literally hundreds of technical indicators out there, each with its own strengths and weaknesses. Some popular ones for scalping include moving averages, the Relative Strength Index, RSI, and the MACD. These can help you spot trends and potential reversals. But remember, indicators are just tools. They don't predict the future. They simply provide information based on past price movements. It's up to you to interpret that information and make informed trading decisions. Let's start with moving averages, one of the most popular indicators used by traders of all levels. Moving averages smooth out price data over a specified period, making it easier to identify trends. They help cut through the noise. For scalping, short-term moving averages, such as the 5, 10, or 20-period moving averages, are commonly used. These react more quickly to price changes, which is exactly what we need in a fast-paced environment like scalping. When the price crosses above a moving average, it can signal a potential buy signal, while a cross below might indicate a sell signal. Of course, it's not that simple, but it's a good starting point. Now, let's talk about the RSI, or Relative Strength Index. This handy indicator measures the magnitude of recent price changes to evaluate overbought or oversold conditions in the market. Think of it like a momentum gauge for a stock. The RSI oscillates between 0 and 100. Generally, readings above 70 are considered overbought, while readings below 30 are considered oversold. These can be potential reversal zones. For scalpers, the RSI can be a valuable tool for identifying quick price swings and potential entry and exit points. It's all about timing those trades just right. What's going on, everybody? It's Jerry Lowbrow, and let's talk about why risk management is the most crucial aspect of scalping, even more so than in other trading styles. See, in scalping, you're making a high volume of trades in a short period. This means even a small loss per trade can quickly snowball if you're not careful. Imagine this. You're making 50 to 100 trades a day with a 1% risk per trade. A couple of losing streaks, and you're down significantly. That's why understanding and implementing robust risk management is non-negotiable in scalping. The name of the game here is preservation. You're not looking for those massive, life-changing gains in a single day. Instead, you aim for consistent small wins while minimizing losses. This approach allows you to stay in the game longer and compound your returns over time. Remember, your number one goal as a Forex scalper, especially when starting, is to protect your capital. It's not about getting rich quick. It's about building a sustainable trading career, and that starts with managing risk effectively. Now, let's dive into the nitty-gritty of how to manage risk effectively in scalping. One of the golden rules, and something I personally live by, is the 1% rule. This rule dictates that you should never risk more than 1% of your trading capital on a single trade. Let's say you have a $10,000 trading account. Following the 1% rule, your maximum risk per trade would be $100. This approach ensures that even a string of losses won't cripple your account, giving you room to recover and keep trading. But hold on, how do you actually enforce this 1% rule? That's where stop-loss orders come in. These are preset orders that automatically close your trade when the market moves against you by a certain percentage or pips. By setting your stop-loss at a level that limits your potential loss to 1% of your account, you're effectively implementing the 1% rule. This way, you take the emotion out of trading and stick to your risk management plan, even in the heat of the moment. Scaling in and out of trades is another fantastic risk management technique that can be particularly effective in scalping. This strategy involves entering and exiting a trade in multiple smaller increments instead of going all in at once. Think of it like this. Let's say you've identified a promising trade setup. Instead of buying 1,000 units of a currency pair at once, you could scale in by buying 200 units at your initial entry point. Then you buy another 200 units if the market moves in your favor, and so on. This way, you're not risking your entire position on a single price point, and if the trade moves against you early on, your losses are minimized. Similarly, you can scale out of winning trades by taking profits at different price levels, locking in gains as the market moves in your favor. Mastering the art of scaling in and out takes practice and a keen understanding of market dynamics. However, it can be a game changer for managing risk and maximizing your returns from successful trades, especially in the fast-paced world of scalping. What's going on, everybody? It's Jerry Lowbrow, and let's get right to it. In Forex scalping, timing is everything. You don't want to be scalping when the market is quiet because then you're just not really doing anything. And you're also not going to be scalping when the market is extremely volatile because then you're just asking to get blown out of the water. So when is the best time to scalp? Well, it all comes down to liquidity. You want to be scalping when the market is most liquid, which means there are a lot of buyers and sellers and the spreads are nice and tight. That usually happens during the overlap of the London and New York trading sessions, which is between 8 a.m. and 11 a.m. Eastern Standard Time. During this time, you've got traders from both sides of the pond placing trades, which means there's a lot of action and opportunity. Plus, since the spreads are tighter, you're not losing as much money on each trade in fees. Now I know what you're thinking, but Jerry, I have a day job. I can't just sit at my computer and scalp Forex all day. And you know what? I get it. That's why it's important to find a strategy that works for you and your schedule. If you can only trade for a couple of hours a day, that's fine. Just make sure you're trading during the most liquid times. Now, I know I said you don't want to be scalping when the market is extremely volatile, but that doesn't mean you should avoid volatility altogether. In fact, a little bit of volatility can actually be a good thing. You want to aim for that sweet spot where there's enough movement to make some quick profits, but not so much that it's impossible to manage your risk. The key is to identify periods of predictable volatility. For example, you might find that the market tends to be more volatile in the hour after a major economic news release. Or you might notice that certain currency pairs tend to move more than others during certain times of the day. By understanding these patterns, you can time your trades to take advantage of the volatility and maximize your profits. But remember, even when the market is volatile, it's important to stay disciplined and stick to your trading plan. Speaking of economic news releases, it's important to keep an eye on the economic calendar if you're scalping Forex. Major news releases, like interest rate decisions or employment reports, can cause some serious movement in the market. And as a scalper, you want to be on the right side of that movement. Now, I know some people like to trade the news, and that's totally fine. But if you're new to scalping, I would recommend avoiding it altogether, at least until you get a little bit more experience under your belt. Trading the news can be extremely risky, even for experienced traders. Instead, what I recommend doing is avoiding trading altogether during the 30 minutes before and after a major news release. This is when the market tends to be the most volatile and unpredictable. Once the news has been released and the market has had a chance to digest it, you can then start looking for trading opportunities. All right, so you've learned about the importance of timing and volatility, and you're ready to start scalping Forex. But before you do, there's one more thing you need to do. Set up your scalping strategy. And the first step is choosing the right broker. The broker you choose can make or break your success as a Forex scalper. That's why it's important to choose a broker that offers tight spreads, fast execution speeds, and a reliable trading platform. You don't want to be stuck with a broker that's constantly lagging or giving you requotes. That's just going to eat into your profits. Now, I'm not going to recommend any specific brokers because the best broker for you is going to depend on your individual needs and trading style. But I will say this, do your research and compare different brokers before you make a decision. Once you've chosen a broker, you need to start thinking about your trading strategy. And when it comes to scalping, technical indicators are your best friend. Technical indicators are mathematical calculations that are plotted on a chart and can help you identify trends, momentum, and potential trading opportunities. There are literally hundreds of different technical indicators out there, but you don't need to know them all. In fact, I would recommend sticking to just a handful of indicators that you understand and are comfortable using. Some popular indicators for scalping include moving averages, the Relative Strength Index, RSI, and the MACD. Moving averages can help you identify trends. The RSI can help you identify overbought or oversold conditions, and the MACD can help you identify changes in momentum. Now, I know all of this might seem a little overwhelming, but trust me, it's not as complicated as it seems. The best way to learn how to scalp Forex is to just jump in and start practicing. But don't go risking your hard-earned money just yet. Start by practicing on a demo account. A demo account allows you to trade with virtual money, so you can get a feel for the market and test out different strategies without risking any real capital. Once you're consistently profitable on a demo account, you can then start thinking about trading with real money. But even when you do start trading with real money, it's important to start small. Don't go all in on your first trade. Start with a small amount of capital that you're comfortable losing. And as you gain more experience and confidence, you can then start increasing your position size. So there you have it. Everything you need to know about Forex scalping in under 10 minutes. I know it's a lot of information, but I hope you found it helpful. Just remember, scalping is a skill that takes time and practice to master. Don't get discouraged if you don't become a millionaire overnight. Just keep practicing, stay disciplined, and never stop learning. And who knows, maybe one day you'll be the one teaching me a thing or two about Forex scalping. Until next time, happy trading!